In on the show today, we have Julian Brigden. He's the co-founder of Macro Intelligence, two partners right here with us. And good to have you on board. Thanks very much, Julian, for taking time out. To begin with, it seems like the markets have already priced in a 25 basis points rate cut by the US Fed. What do you think is going to be the likely impact of that now on asset classes?
So I think you're absolutely right. The market's priced in 25. In fact, it's priced in more than 25. If you look at the odds of a 50 basis point rate cut, particularly after we had some comments from the Fed today, in actual fact, we're pricing close to a 40% chance of a 50 basis point rate cut. I'm a little concerned, I'll be honest with you, that if they only were to deliver 25 basis points, that there's actually some risk of disappointment in the bond market, unless it comes along with a very, very dovish commentary that almost guarantees a rate cut again in September. I think the bond market is more than priced in 25. As I said, they're betting on 50. I think it also would be a slight disappointment if we only got 25 to the equity market, particularly some of those very high-flying FANG type stocks or the growth stock sector, which seems to live off super cheap money. And it would obviously be pretty bullish for the dollar, potentially a setback for some of the commodity trades.
All right. Julian, do you see two more cuts then next year?
I think this is the fundamental question here. I think, the market's concept of what the rate cuts that are necessary to, should we say, extend the economic cycle are very different from the Fed's concept. So if you look back at, say, 1994, 1995, where the Fed punted the cycle, so to speak, they extended the cycle by giving sort of interim cycle rate cuts. We got a total of 75 basis points. And I think that's probably realistic, 50 to 75. I just think, we've seen times when the market has been betting on considerably more than that. So I think, look, if you get 25, I think there's a risk of a bit of a wobble in risk markets, a backup in bond yields. I suspect that probably forces the Fed to deliver in September unless the data gets very much better.
Right. Julian, so do you see a risk of a bubble in the US equity markets?
I think they are. I think there's certain sectors that you could absolutely argue in a bubble. I mean, we flagged up back in September, October, some what we refer to as classic bubble charts. And they're just literally a technical trading pattern that we use based upon historical patterns from everything from the crash of the Dow in 1929 through to the Nikkei that we saw and the NASDAQ in 2000. And we flagged some of the FANG stocks. Amazon, Netflix, Nvidia were all in those patterns, which suggest extreme overvaluation. If you look at the broad S&P growth versus the S&P value, we've actually pushed that ratio back to the highs of 2000. So I think it's possible to argue that in certain sectors in the US equity market, we definitively have bubble-like conditions. And particularly, as I said, in those very growth-orientated stocks, which are really only growing because money is cheap. There's nothing about real growth. It's just revenue growth.
Right. But what about bond markets? Given the kind of inverted yield curve, is that overblown as well?
As I said, I think here's quite a difficult situation. I think you've got some, as I said, some tactical concerns about the yield curve. We did see that certainly an inversion in the forward curve. We never actually saw one in the cash curve. We've skirted with those sorts of levels. Look, at the end of last year, was betting on rate cuts in the US. I think we're going to get those rate cuts. I'm just worried, as I said, as to how much the market thinks is necessary to do that. I think that they may be over-exaggerating how much the Fed will cut. I think there are risks of a spike and a steepening of the yield curve, but it would be a bear steepener at this point, led by a sell-off at potentially the long end. And bigger picture, if the Fed is determined, which is what Powell told us at the last FOMC meeting, to extend the cycle, then that is ultimately reflationary, which, as we saw, say, back in 2016 when Janet Yellen did exactly the same thing, ultimately became inflationary. And in that environment, I'm not a big fan of the long end of the US bond market.
Julian, what's the outlook when it comes to the dollar?
I'm actually, we were big dollar bulls right until the end of last year, and we've been sitting on our hands since then. But one of the things that I've started to notice, and I think you're also seeing it in the precious metal market, which we've recommended to our clients to be long for a few weeks now, you're starting to see nascent signs of dollar weakness. The problem is a lot of clients and a lot of people tend to look at these baskets of the dollar. So they look at things like the DXY. And the DXY is very heavily euro orientated. But once you strip the euro away and you look at some of the individual pairs, you're starting to see signs, I think, of a clear dollar topping pattern. As I said, I think if the Fed messes up this messaging around the next FOMC, you could get a bit of a chop. But I generally think we're starting to see signs of the dollar rolling over. If you look at a very long-term cyclical pattern, the dollar tends to trade in very, very clear cycles. It falls very aggressively, it's reflationary, it then bounces, it's disinflationary, deflationary. And we've come to the end of what historically should be one of those patterns, and we should be entering a multi-year down cycle in the dollar. Don't think we're quite there yet, but I'm seeing nascent signs of that. And that would be, I think, tremendously good for the world. As I said, it's generally reflationary as the dollar falls. It's great for emerging markets. It's good for commodities. It's not great for the end of the bond market, the long end of the bond market.
So do you see more money moving into emerging markets then in the current environment, or do you think we'll continue to see safe haven demand?
As I said, I think it's early days yet, but we have started to see, if you look at, say, the emerging market index EEM, we started to see that push up towards that sort of 45 level, which has really been a cap for quite a considerable period of time. I'm a little, as I said, nervous about how the Fed handles this next FOMC, but generally, yes, I'm looking for opportunities to buy emerging markets. I've been looking at Brazil very closely. I think Southeast Asia is a little bit more complicated. At this stage, I'll be looking at some of those commodity-orientated emerging markets. But generally, yes, if we're about to enter a down cycle in the dollar, albeit it takes a bit of time to get there to that defined trend, yes, I'm positive on emerging markets.
Right. And just moving forward, what is your own sense on what then is the outlook on FANG stocks? I know you earlier just briefly highlighted and mentioned them because a lot of interest, even locally, is on what's happening there and whether or not it's another big bubble which is just waiting to burst.
Look, they've been a fantastic trade. I think they've benefited from a number of factors. Super cheap financing is one of them. As I said, these growth stocks really only grow when nothing else is growing, and they just borrow huge amounts of money either from the equity market or from the bond market directly to funnel that revenue growth. I think if we are entering a period of, albeit a little choppy, a steeper yield curve, and higher longer end bond yields, that's generally not good for these guys. I think there's certainly a significant regulatory risk around some of these names. Some of these names are also highly inflated on a relative basis to value stocks in the broad economy. And then finally, if what I'm hearing is correct that came out of the G7 meeting today, we may have just agreed a deal on how to tax these global tech companies, and it is not a good one for them. What it appears to be is we may have agreed to tax them on the basis of where revenue is derived and not where they are domiciled. And that means significantly higher tax rates for these guys for revenue that they derive in many countries in Asia or particularly in Europe.
Julian, great to have you on the show. Thank you so much for taking the time out and speaking with us today.